for the market to want to come back and reprice into these areas. So when I'm looking at price, I have all of this higher time frame weekly perspective in mind. So if I were asked which time frame do I spend the most time on, it's the weekly chart. So in my mind, I like to look for those first. And if there is no inefficiency, then I'm looking for liquidity. What I'm trying to predict and or anticipate is where is the present weekly candle reaching for higher or lower prices. If I see an inefficiency, I'm expecting price to try to draw down into that. If this inefficiency wasn't there, I would look for that low because that's where sell side would reside. Or consequent encroachment, which is the midpoint of this candle's tail. I would either look for that midpoint of that candle's tail, or I would use the low of that wick. If there was no inefficiency that's shaded in purple, if that wasn't there, I would be expecting price to draw down. Now, why would I expect that? Because we already hit our targets that I covered in the previous weeks. Once a target's met, whether for the week or a day, you have to get comfortable, grow real comfortable with just simply sitting still and waiting. Move slow when you're trying to make money. Move fast when you're trying to preserve it or protect it. It's only going to go up for one of two reasons. Price delivery continuum is the movement from where price is right now to future delivery. So where it's going to be 5 minutes from now, a week from now, 2 days from now, 2 sessions from now. It's going up to take out buy stops, or it's going up to trade into some kind of inefficiency, like a fair value gap. That is it. That's the only two reasons why price goes up. And if it's going up, what liquidity is that? Buy side liquidity, buy stops. When price is moving back and forth in a defined range, price has moved rather efficiently inside that pink area, up and down. Where are the inefficiencies and where are the stops? The first thing I'm looking for is inefficiencies, because that's the array that the algorithm reaches for first. If there's no inefficiency and we're in a premium and we're likely to go lower, then it's going to be looking for sell side. Reverse that. If we are in a range and we're in a discount and there is no inefficiency above price, but there's a short-term high, it's going to run for the buy side. You see this pink shaded area? How the market entered it, went up to this candle's high. The next week we opened up here. Then we traded higher up to this point here. Then the next candle or next week we open, we trade down and overlap all the way and into the previous high. So there's no fair value gap formation whatsoever in the candle I'm highlighting right now. So what is actually happening there? The price has gone up and down, up and down. So at that time, when we start on this week, we open, we rally up, make the high, and then we close after making a low here. So there's been a lot of delivery up and down in between the range high and the close of this candle here. Think about what I'm showing you here and how that relates to this area right over here. That same idea, we can apply it to over here. Same thing here. Price opens up, trades higher, back and forth delivery, all the way up to the high, back and forth, and then we leave it. So before this broke down, is there any inefficiency over here? Right here. So there's a gap there. So we have an inefficiency here. So when the market leaves this range, it's in a premium relative to the low and where it traded to. It's in this range consolidating, and then it leaves it. Where's it going to go? Well, there's several things. You can use the consequent encroachment of this wick, midpoint of that. Then you have the gap here. This traded down into, but left the majority of the gap still untouched, right? So when it drops here, price is going to want to trade into this area here. And again, that would be bias. That would be bias for that particular week for the dollar. What do you think that would mean for you Forex traders that want to trade pound dollar? You would go into your charts and back test any long positions during the London Open between 2 o'clock and 5 o'clock in the morning, New York local time. You would look at your AM session kill zone, the New York kill zone, between 7 o'clock in the morning and 9 o'clock New York local time. You would look for the model 2022. You would look for optimal trade entries. You could look for silver bullets, because silver bullets form in the kill zones between 7 o'clock and 9 o'clock. Ooh, what'd I say? Yep, we're teaching that again today too. It's not limited to just index futures and 10 o'clock to 11 or 2 o'clock to 3 o'clock in the afternoon for index futures. If you're a Forex trader, everything that I teach is applicable. Yes, there are silver bullets between 10 o'clock and 11 o'clock in Forex, but they are really good ones between the 7 o'clock and 9 o'clock New York Open Kill Zone and between 3 o'clock and 5 o'clock London Open Kill Zone. They're there every day. I want you to think about how the market moves in these ranges. This is a balanced price range. Why is that a balanced price range? Because the market has moved up and down within it, and then it left the range. Market's going to go where the market's going to go. It's predetermined. Your daily high and low is predetermined. How can we determine where that likely higher low is going to form, or where would it likely reach to, starting on these higher time frame weekly charts. And if we know that we can see prices likely to want to expand lower, I'm trying to determine what's the strongest directional bias that can be derived by looking at the weekly chart. What is it likely to be reaching for on a weekly candlestick chart? Every weekly candlestick, high and low, is a factor as well. They're going to be used. Again, they don't just get used one time and they expire. I teach there's a 60-day look back, and the highest form of precision or highest form of accuracy in terms of my key levels, I define it within that 60-day range, and it's 60 market days, not 60 calendar days, obviously. So what I'm looking for is the highest high and the lowest low in the last 60 days. I'm looking for inefficiencies in the last 60 days, whether it be premium or discount. That means a fair value gap like that purple one here was. When I look at this range, this shaded area, it doesn't look like a fair value gap on the daily chart, whereas that is a fair value gap. You see that right there? Notice that that is not what you see inside of the shaded area here. That was the weekly inversion fair value gap. So the price delivery continuum is when you have these higher time frame inefficiencies, regardless of whatever time frame it is, when you drop down to a lower time frame, you cannot ignore or forget the impact that those higher time frame inefficiencies will have on the lower time frame. The lower time frames you can use for precision, like refining risk and making it much smaller so larger positions can be assumed. That down close candle, I told you, was a bullish order block. It's a change in the state of delivery. That's what an order block is. It's not every down close candle or every up close candle. What's occurring here is at that candle's that candle's opening price was the only marker where price can be measured in this time frame where price was offered down. Where was the next down close candle? Right there. So between those two down close candles, if we're looking for a sell model to begin, where could we expect that to form? The fair value gap that I shaded and I told you on the 13th. It's an old weekly imbalance. So if we leave an imbalance, what was I teaching you on the weekly chart? The market can be efficiently traded back and forth. I'm looking at where price has been, where it went to recently, and is there any pockets of inefficiency in there? Look at these three up close candles right in here. Listen close. ICT, why do you use the last candle on some examples and other times you use the consecutive candles? Well, all of these are inside of this fair value gap, that shaded area, which is an old weekly fair value gap. If they're consecutive like this and they're inside that range, I'm going to use the entirety of all of that, because the beginning of this opening on this candle here and the next candle and the next candle, that's all one price delivery for buy side. It's delivering buy side delivery. So that means there's movement up. So I want to refer back to that opening price right there, because that starts the order block. And the mean threshold would be the middle of the low of this candle to the high of that one. So we have the low of this candle up to the high. We allow, listen folks, we allow for price to trade to and through, but not close, listen, not close above mean threshold. So the wicks do the damage, the bodies tell you the story. Look what's going on over here. See all that? Opening price, so here's mean threshold, so that's what I'm identifying here. This level, that opening price, that is the change in the state of delivery. These consecutive up close candles is one order block, meaning that inside this shaded area, right before this market changed and went lower, my eye goes right to that opening price, because I'm using all three of these candlesticks, because it's inside of a range. I've already told you on the 13th, we want to treat that range as a inversion fair value gap. In other words, it's an area where the algorithm will go up, spend some time in there, allowing smart money. They're using this frame of reference because they want to sell short here and buy at a lower price down where the order block is here. An order block is not orders. It's where the market changes its state of delivery, meaning that inside this shaded area, we want to see the price go up into it. Does it do it? Yes. And then once this candle's opening price, that is the beginning of these three consecutive candles, and I'm using all three because it's inside the area I told you to define as the reason to anticipate price going lower from the beginning, right? We want to see signatures. That means evidence in price delivery, in price action itself. Does price show a willingness to treat this shaded area as resistance? Does it want to send price lower when it enters into it? Where? The low, midpoint, consequent encroachment, and the high. We don't want to see the high end of an old fair value gap if it's being treated as an inversion fair value gap. The better setups form if the high, if you're looking at it as a resistance or using it as the beginning point or inception of a sell side delivery or sell program, we don't want to see the high traded to. Treat that like the same thing I treat a breakaway gap, which is a fair value gap that won't completely fill in. If it gives you that signature, which is what we're seeing here, as soon as price breaks below the opening price here and leaves the shaded area that's in like a pale orange, once it does that, that qualifies that right there as a bearish order block. Why? Because the state of delivery changes from buy side delivery, then it crosses over the opening price there. Just because it crossed below an opening price of a series of up close candles doesn't make it an order block. The narrative behind where that order block resides, that is the imperative point that everybody is missing. You also have a breaker. High, low, higher high. Consecutive down close candles. Same thing we're applying here. All these ranges here, push it forward in time. You're getting the same entry here. Stop above here. The entries are the least important thing. I'm going to say it again. Where you enter is the least important factor in consistency. It is the least important thing. You have to know this. Where is it going? Because if you can determine where it's likely to go to, you can find a myriad of entry points. When price returned back up into this low here, right there, you can be short. What would you anticipate? This rejection block, which is the lowest down close, that's your first draw. Below it, sell side. And then you can start doing projections on all this price run here, lower, to see if it wants to dig in lower. It's Friday. It's already hit the mark here. You can use this as an entry going short. Well, look at it. Look what it did, Michael. It ran up here. Yeah, I know. But you're trading with a higher time premise, meaning you're entering here. Where's the model call for a stop loss? It's got to be above that high. If you're using the last up close candle, the same thing. You don't get short here, but you can be short here. The stop's got to be above here. Price alone, that's the instances where price returned to the PD array. Now here is where you separate the men from the boys and the lions from the sheep. Time. Just because price went up to that level right there at 2 o'clock in the afternoon, are you factoring a great deal of emphasis on a late afternoon dollar? No. You want to focus on the relationships of what the dollar's doing during key kill zones. Dollar is going to be highly sensitive to Forex. S&P, NASDAQ, Dow. It will use the longer term higher time draw of risk on risk off with the dollar, but sometimes the index can flex against that. But you don't see that with euro and cable unless dollars being manipulated, held in consolidation, which it's not being here. It's being allowed to move, gyrate, move around. That means that your Forex pairs can be free to move around and have a lot more volatility as well. So if there's an emphasis on dollar usage in your analysis, just know that there is a much more impactful driver of price when you're using dollar when it comes to currencies. Now, we have the market run up into during Wednesday at 2 o'clock. What is going on there? We had another market event that day, big calendar event, medium impact, high impact news drivers. We can anticipate on that weekly chart where the inception of the majority of manipulation will begin based on the calendar. 2 o'clock on Wednesday. Where are we at here on Thursday? What time of day is this? London open. This entire down close candle here, that range is the order block. If we're bearish, we want to see it trade initially into the open of it because that's this change in the state of delivery. And then we want to see it try to reach for the mean threshold. How we know if it's going to continue going lower is how we close after hitting mean threshold. That's part of order block theory. If it closes below the mean threshold, chances are we're likely to see it want to continue going lower. If it were to go lower, we have a small little portion of this gap that's being shown from this candle's high and that candle's low. So that little gap right there, that's a small little area that's still exposed. So if we were to close below this middle of this candle, bullish order blocks are not always buying opportunities. They're targets and are also means of measuring order flow. If we close below the mean threshold, half of that candle's body, if it closes below that, it is indicating that it might want to still keep going lower into next week. And if it does, where would it reach for? Sell side below this candle's low and into that small little inefficiency. And if it accelerates, we have another fair value gap right here. Now, when we look at the dollar for Forex traders, you're really going to be focusing on like the London open kill zone, the New York open kill zone. And again, for the London open kill zone, it's all New York local time. It begins at 2 a.m., ends at 5 a.m. I personally personally, I use 1 a.m. as a buffer. And to me, that kind of like cancels out any tomfoolery that would occur because of daylight savings time, which I wish they would abolish it. But to remove all the uncertainty about time, I've always used my personal is 1 a.m. to 5 a.m. Any setup that I like to look for can occur that early, which is kind of like the European Open. And then you have at 2 o'clock, it's the London Open, and the volume peters off at 5 a.m. And in between 5 o'clock in the morning to 7 o'clock in the morning, I refer to that as dead time. Don't try to do too much anything in here. But I have taken trades as early as 6 o'clock in the morning, trading the New York session or the New York Open kill zone, which is classically defined by 7 o'clock in the morning to 10 o'clock in the morning. And you can look at 7 o'clock to 9 o'clock as that little sweet spot where the majority of your trades are going to form buy or sell for Forex trading between 7 o'clock in the morning and 9 o'clock in the morning. So if you look at the range here, we're going to measure the high. So we can see that the highest point here, and it might not be the very pipette, I could care less about that, but the low and the high, I've dropped the Fibonacci on that. The midpoint of any gap, that being a fair value gap or a real liquidity void. A liquidity void would be like this little area right there. See, there's no overlapping of any wick or candle body. It opened here and it closed here. There's no price data here at all. That's a real liquidity void. That's a real gap. If we're bearish, we want to see the upper end of the inefficiency or gap respected and treated as a premium and not be dug into. If the market is really, in fact, in a sell model, the best ones, the strongest delivering obvious runners will always have this signature hallmark part to it where the upper portion of it doesn't get traded to. Look at the bodies of the candles. We have just a little bit of movement above it here, but look at these right there, right on that midpoint of that. You think that's random? You look for in time periods of the day where I teach you as kill zones. London, if we have a bias that is indicating that the market is likely to expand lower on the weekly chart, that means the candle's going to expand down. Right away, 80% of your bias problem has already been solved by itself with that alone. The bias is derived from the weekly chart and where it's likely to draw to. That's it. Then you're moving on to the daily chart. And the daily chart is you're watching and monitoring how each individual daily candle forms. If you're bearish, we want to see how does price gravitate to this level down here, which is that bullish order block. So each individual day, we want to see, does the algorithm offer price there? And if it does, once it enters it, at what time of day? Well, what market are we looking at? So primary interest is nailing down the high of the day. Where is the high of the day going to form in a market that is trading at a level we expect the price to react to? So we're expecting the inception of a down move between one of three levels in here, right? No, midpoint or the low of that shaded area. Remember what I said. If we're bearish, every inefficiency, if we're going to use it as a basis or a framework for a trade, we want to see in a premium array that's going to be used to sell off and send price lower. Because if it doesn't get up there, like we're seeing right here, that's really indicating that this is going to be a strong probability to trade down to and through that order block. Time of day now. Okay, so here's London Open, and we're dealing with the dollar index. And I mentioned on the 13th that we would want to see the price of dollar go up into this shaded area, which is the old inversion fair value gap on the weekly chart. Inside this window of time is when the trade begins, when the shift in market structure will occur, when the high of the day forms. 70% you have a probability that the high of the day will form between 2 o'clock in the morning and 5 o'clock in the morning, New York local time. So when we're trading at consequent encroachment here, and it's in London Open, we bump the high. We want to see price do what? Show unwillingness to want to go lower. Does it sharply leave once it trades up in here, hits the buy side here, and then all this back and forth movement that I'm showing you right here, all this here, price is spending time in that range. Is it efficiently delivered? Yes. Why? Because it's moved up, down, up, but it's only keying off of the levels I told you to focus on inside that shaded area. Consequent encroachment. We want to see, does it reject after bumping the high here? Yes. Once it leaves that shaded area, how did it leave it? Energetically? Yes. So now, enter model 2022. Buy side taken here. Shift in market structure there. Fair value gap there. And then over here, what time of day is that? 8 a.m. So you're in the heart of what? New York Open kill zone. 7 o'clock to 9 o'clock. That's your little sweet spot. Okay, so inside this little window of opportunity here, you're focusing on what? We've already worked up inside that consequent encroachment here. We've already seen the evidence that it wants to reject that. We have a shift in market structure. We have a fair value gap, and the market rallies up into what? Time of day. That's when the move's going to happen. New York local time. This is your premium array. The range is from this high down to that low. That's the lowest low. Here's 50%. A premium is at or higher than that. Does that fair value gap qualify as a premium array relative to that high and that low? Yes. Is price returning back up to that shaded area? Yes. Where specifically? The low end of it. It doesn't need to go back up to consequent encroachment. Consequent encroachment, it showed the signature that we would look for. It left the upper portion untraded to, again, worked off the low of that gap. All right, so the idea of how far price runs can go, I'm going to use that here. This range is the entirety of the order block. And the expectation is we want to see it trade down to consequent encroachment and go below it. We want to see that weakness, that heaviness, because we want to see the move protract further lower, which would give momentum to being a long holder to stock index futures and foreign currency. This move right here, that is your trigger swing. That's the measuring point for what you want to see for protractions. So we have a high to low, and the entirety of that daily order block is shaded in yellow. Notice that Fibonacci extension negative 2.5, which is 2.5 times the range of the low to high here. This is the range that matters, and there has to be a confluence of time being London close, begins at 10 o'clock in the morning New York local time, and ends at noon. There is a buffer I add to it. When there's a big runoff day, it can extend into 1 o'clock. It's far and few between. If you use just the 10 o'clock in the morning to 12 noon New York local time as your London close kill zone, it will serve you well. Huge step forward, Eddie. Watch. At 10 o'clock in the morning to noon, these mysterious markets. Okay, we want to know where price can begin a move and where it can gravitate to. Where is it drawing to? It's drawing liquidity. And we want to frame it in the form of a low-hanging fruit terminus. The inception of a move can be timed. The inception of the move can be determined within a specific price level or within a range like an inefficiency. And in that range, there's 3 specific price levels. 3. That 3 levels is used on a basis of whether we're bullish or bearish. So as I was mentioning earlier, we were expecting this shaded area up here on the weekly chart, that old inversion fair value gap, to be treated as resistance. The algorithm would trade up into it. During time, notice that it reacted here. This is the essentially the midpoint or consequent encroachment of the entire range. But look at the time of the day. It's 1 o'clock in the morning. That's European and open, yes. But the heart of the move, and what I teach by rules, is the high and the low of the day is formed between 2 o'clock and 5 o'clock in the morning. When we get here at 2:45, we're doing 2 things. Number 1, we're bumping the high. So anyone that went short up here on dollar-based ideas and long foreign currency during the London open kill zone, then it creates the high. You have a 70% probability of the high forming when you're bearish. This level right here is your low-hanging fruit objective. That's not the end of the road. It means that you frame that idea of taking a trade with this as your draw on liquidity. So if you were to look at a breaker here, you have a high, low, higher high. Extend the breaker over, you'd be entering short there. If you're using optimal trade entry, that high to low, it trades up into, I'm quite certain that's probably 70.5, which is the sweet spot that I teach on optimal trade entry. That trade up into that right there is perfect. And it's just a beautiful run from there down. Entering on the fair value gap here, which is the 2022 model. So right away, there's 3 ways of getting in it. But we have this run here to here, and we have a standard deviation of negative 2.5, which is just outside the scope of the entirety of that daily bullish order block, which is that shaded area in yellow. That full entire range. As soon as we start moving past midpoint, an order block's midpoint is mean threshold. Any inefficiency or gaps midpoint is consequent encroachment. The mean threshold here, if we trade through that when we're looking for lower prices and such, that really bodes well for leaving something on like a partial. You don't need it to do all this. You just needed to get here, right there. And that's not even your first partial. Your first partial would be something like below here or at the the consequent encroachment of this wick right there. So midpoint of that wick, that low or that low, which one do you choose as your first partial? Neither one of them are incorrect. But you're framing with this is where you think that the low-hanging fruit objective is. So that's your initial draw. And then you watch and see once it gets there, you leave a partial on. Your analysis needs to make room for you to be wrong, but not unprofitable. You're always looking for a way to take something out. All of this movement here is just this buy side imbalance, sell side inefficiency now has been what? Sell side's been offered to it now. Look at the bodies of these candles. Look at that candle stopping right there after this buy side has been repriced with sell side. So the down close candle now has provided a repricing to this inefficiency. That starts the framework of this Judas swing for the New York Open. This little run from here to here is power 3. Power 3 is not limited to the daily candlestick. Power 3 can be utilized in any time frame. But this market protraction, this false move up to a level which is the low of that old weekly fair value gap. If you see the London high form when you're bearish and it's breaking down and you retrace in New York, chances are you're retracing to have a continuation lower. Whenever there's a wick, if your position affords it, always, if the price trades to a consequent encroachment of a wick, you must take partials if you're short just above it, because that means it might trade right to that midpoint of that, stop on a dime and retrace and spend some time consolidating, or all right, just reverse. But these wicks, these tails, okay, when you have two of them back to back like that, you're taking the longest one, divided in half of that plus a little bit for spread. Time, London Open, New York Open. Price, consequent encroachment of the gap, low of the gap. All other factors being there, the market starts, breaks. Once this low is broken, we don't know if it's going to go down here. We don't even know if it's going to go here. We're trusting that it's going to go there, which is why you have a stop loss. We measure how we trade once we take that low out. Does it do it energetically? I would say that's the energetic. The next candle, we open here. The market trades up into the range of this high and this low, essentially about half of it. When we see that, the next candle, we want to see it break lower and treat this as an order block. We open, rally up, trade down, we trade through it. It does not need to close below it. Mean threshold is important when we're trading down to an order block for targeting purposes and or continuation. If it closes below mean threshold, that's an indication that it's likely, not a promise, it's an indication that it's likely to continue moving lower. We went through that easily and then traded outside of the range of that order block. So now, since we've done this level here, mean threshold, now becomes critical. This section of price action, if it's going to continue, it's best for it not to trade back up into this area here. And because of that, I would treat this as an area of a fair value gap that I want to see stay open. This low and this high, I wouldn't want to see it trade up in. Now it can trade up to the midpoint, which is mean threshold, go just above this candle's high and then resume going lower. That would be institutional order flow entry drill, trusting that this is not needed to be traded to or up into this area here. The point is we trade down into targets until we get to time. The high of the day formed in London Open, exactly how I teach it 70% of the time. If you're bearish, the high is going to form between 2 o'clock and 5 o'clock in the morning, New York local time. If that is true, New York session will have a high probability of continuation of the same direction that London already establishes. That means the high is formed in London. We have a price area that we want to see respected. We've already worked at the midpoint of that old gap. The low is now the sensitive price point. That's the level of price, but it has to be traded to at the time of day that the algorithm will refer to for new delivery. New delivery is a lower low in the day. This protraction higher up in the New York Open, and the time and price is meeting right here. Then we have this acceleration to the downside until we get to when London close starts at 10 a.m. Now at 10 a.m. you're watching, does price hit your target or multiple targets? If it does, now you're in a position where you could potentially see a market reversal profile. London close generally makes the extreme end of the day. So if we see the high of the day form in London, the low of the day forms generally in this little time window here between 10 o'clock and noon. What is this little time window here between 10 o'clock and noon? What is this high right here? Last up close candle, what is that? It's not a breaker. What is the purpose or function of a breaker? Mitigation. So a breaker, if it was a bullish breaker, we would see a low, a high, and a lower low than that low here. But we're not seeing that. We see a low, high, low, a higher low. So it didn't go lower here. So that makes this high here a mitigation block. Similar in scope, but the definition of what makes it a mitigation block is that distinctive feature. So if you take that range here, so if you are a euro dollar trader, you want to constantly be referring to what you're seeing on the market that you're trading versus the dollar index. So everything you're looking at in price, you're constantly getting feedback in relationship to the dollar index. As soon as we enter in London close, you have to have the majority of your trade off. Classic signature of London Open is a stop run. London Open classically seeks sell side or buy side liquidity. You don't have to have the confidence to go in and buy the sell stops. It's easier for you to wait for this run here and then judge, does it have displacement higher? Swing high after it takes stops. We want to see energetic run once it clears this high. Does it do it? Yes. In itself, at this time of day, is 3:55. What time of day is that? London Open Kill Zone. This fair value gap right here is the silver bullet for euro. You only need this low right here to trade to. What time is that? 4:20. Sorry, just a joke. Some of you probably won't get that. No, I don't smoke weed. But there's your silver bullet for London Open. And it rallies up to what? The low of that fair value gap I told you on the 13th of June. That is what? What is that? That is your low-hanging fruit objective. Now, why am I not using the low of the order block? Because that gap is there. The inefficiency takes precedence over the order block. Yes. This is where you would see it reach for minimum. Does it react there? Sure it does. Trades back down into what? What's it trading into? Low, high, lower low. What does that make this? A bullish breaker. Extended in time. What time of day is that? New York Open Kill Zone. What does it do? Rallies. How high can it go? Well, we have to determine a fulcrum point. Fulcrum point is here. Why is that important? If it runs through this high, we can start doing measurements in the form of standard deviation. So we can take that low, project it up this high here. Standard deviation, -2, -1.5. 1. This is a measured move. You want to absolutely have the lines portion of your trade off there, because what else is that in close proximity to? The high of the order block. Remember this shaded area here? That's what I'm highlighting here, the low to the high of that. And this is the fulcrum point, meaning that when price trades to it and through it, it has to go through it before you can get any of these measurements. -1.5 and 2. That's 2 times this move here. Whenever you get that type of move, that's very, very extended. 2 standard deviations. -2 standard deviation is one of those levels where there's a lot of reason for you to be wanting to be either out of the trade or have such a small little piece on. If you're going to leave a runner on, it's about at that time we usually peter out, especially if we do so when time is met. And that being 10 o'clock in the morning, New York local time, to noon. That's London close. So for your notes, especially for the folks that are brand new, when markets are going down, or we're expecting the daily candle to be a down close candle, between 2 o'clock and 5 o'clock in the morning, generally you're going to see the high form. And generally, the New York session between 7 o'clock in the morning and 9 o'clock in the morning, New York local time, will create a continuation pattern. Now, sometimes there's a reversal of that, where London creates a high, sells off, and then New York runs out the London high, but then reverses and makes the lower close in the day. Those are always on the heels of a high or medium impact news driver. That's the only time that occurs. So how do you know when the low is not going to be taken out or the high is going to be taken out in London? And you can trust the New York session. If I was long on euro, this is running down equity. This is the principle. You see me do it all the time in trades. If I'm long, as soon as it trades above this high, you want to be taking partial and exiting your position. It's offset distribution, and the principle is running down equity. That means you're selling to buy stops. You're selling at new highs. You're buying low and selling high. Where do you define high? Every time it takes out a swing high. When you're long, if it's long in the tooth or it's been going for a long time, like we did here since 8 o'clock this morning, it's good money practice for you to be selling every time it makes a new high. Do you see how the euro has made higher high and the dollar didn't make that lower low at the same time? Market symmetry suggests that in a perfect world, the US dollar should have made a lower low there. in concert with the higher high in euro. This is a USDX SMT divergence. That means dollar and euro are not in agreement with what they've done at a time of day that is critical, loving close. When a seasonal tendency is likely to occur, a seasonal tendency, by the way, if you're new, is simply a certain time of the year, certain month of the year, certain asset classes or a particular market performs a certain way more times than not. Generally, seasonal tendencies state that those are the normalcy. Well, there's a factor in the marketplace that we refer to as a seasonal tendency that I was expecting, and I've used many times over the years, that the low forms in June, and there's a decline the last week of April going down into midweek of the second week of June. Now, it doesn't form all the time, but if a seasonal tendency does not form or continue like it does in the past, the fact that it's not there many times is a very strong indication. A lot of people were trying to, look for shorts. The older timer guys were saying the market's going to consolidate. And I said, okay, well, if the older crowd saying we're going to consolidate and the retail saying we're going to crash, I'm going to trust everything that's saying it's going to go higher. So if they're going to go higher, what's it going to reach for? Buy stops and inefficiencies. Anyway, talking about the Power 3 concept is the accumulation, manipulation, and distribution concept of using it on a interval, any time frame. A market day that has a big range. Usually the open is near the low or the high of the day. So how do you use that information? When you're looking at a day, when you're anticipating bullishness, you're expecting not just one day of movement up, which is why I take you into the weekly chart. That weekly chart might have only a one-day event that creates the run to what we would expect as a draw on liquidity. We look at the weekly chart with the expectation that there's an expansion move. We don't need to predict the close of the weekly candle. We're just looking for this price movement with magnitude reaching into an objective that we've identified on the weekly chart. So because of that, we're taking that insight and we're transposing it to our lower time frame charts, daily, 4 hour, 1 hour, and anything less, all the way down to 5-second charts. I said that correctly, 5-second charts. So if we're bullish and we've arrived at the dollar going lower, cable or pound dollar as we see here is likely to go higher and move up into this shaded area, which is what I referred to as the unfinished business. If it's going to go higher, where is it going to go? Well, you have this high to this low. And what has already happened? We went to this high here. So the minimum threshold would be to what? Reach up to where? This is a trick question, by the way. If you're buying here at the top of this fair value gap as I outlined, that we would be expecting something like that to form, we would expect the market to open, trade down. Any down movement into this gap will be treated as a Judas swing or a fake decline. Retail will chase this every day. They get caught up in it. They want to get short on a breakout, and that is a fake move. It's designed to do that very thing. Why would it be interested to do that? Because those sell stops being triggered to get traders short, chasing it, they think it's going lower, is the perfect counterparty to smart money going in and buying it, because they're the sell side to their buy. Every long has to have a sell side. Every short has to have a long side. The dance between the liquidity and how it's utilized in price delivery, who's available right now to take the other side of my trade and utilize that as like a bus stop between where you are and where it's ultimately going. Terminus is your low-hanging fruit objective. That is not the end of the move. Terminus is just where you define where the low-hanging fruit objective is. If it just gets that far, you've made money. If it reverses there, great, you've already made money. If it continues, you have something there that could potentially pay more, but you don't need it to. If you're going long here and it runs up and hits the low end of that imbalance, that's profit, partial one. Consequent encroachment of that wick, that's a partial. Now, we're expanding. What levels above this buy side can we utilize? The low end of the gap, which is all the shaded area here. Okay. Above this high, we have the low 0.25%, the lower quarter gradient level of this entire range. Then we have consequent encroachment, which is midpoint. Remember, all this movement from high to low, that shaded area, was one weekly candle where it only was going down. So to reprice efficiently, we're seeing price deliver on the upside. So until it gets up to this point here, there is an inefficiency in the form of a sell side imbalance, buy side inefficiency. And then we have a short-term high broke. So now we have a shift in market structure at the low of that weekly inefficiency, that fair value gap. So we have a shift in market structure. Is there a gap? Lowest down close candle. Now, ICT, you said You used all the candles. Why aren't you using both those candles? That candle's outside of that gap. Isn't it outside that shaded area? So what do? You use the down closed last one, bullish order block, trades into it. You want to see it repel price. Does it repel price? Yes. So at this point, you can take this entire range now. For entry, you're going to use a down close. For support, whether the information is going to continue offering institutional sponsorship, the price is going to continuously work off that level, then you can take this range and then apply it here. But the entry would be on that lowest down close candle. It supports it here, supports it here. Look where the bodies are stopping. Why am I not using this down close candle and this down close candle, ICT? It's inside the shaded area, right, of the gap. We have to use the outside of the range. Okay, so we're inside of all this external range liquidity. We have to use the PDA rate that's made available inside of that. And it's separated by this this up close candle. So that breaks the continuity of down close, up close. That's a change in the state of delivery. Then we go back into down close, down close. So the change in the state of delivery is the open on this price there. But for entry purposes, we use that last down close candle. But for supporting for a reclaimed order block, these two down close candles, it's being reclaimed here and here. And we can see that the opens and closes here, that's supportive. And then we have one more little wick through it. Because why? The wicks do the damage. You don't rush your stop loss. Don't rush it up. Okay, and you can see how this type of move right here, FOMC, CPI, non-farm payroll, all those things, they tend to be a characteristic of those types of news drivers. So a high impact news driver, for your notes, it can occur on a medium impact news driver, but most of the time, a high impact news driver is when I expect the worst case scenario in terms of where the safest retail spot of anyone that's in open profit, meaning the market's been going higher. And this is a general rule of thumb. So we're not really talking about this market per se. It's every market. If the market has been going up for a while and it's been classically seen as an uptrend, everybody that's long should be in profit. A high impact news driver, my mindset is always it's going to run against that, either to reverse on them or to offset any trailed stop losses so that way they can be utilized to be a counterparty and then resume that existing primary uptrend for the purposes of unseating profitable positions, and then it resumes. But if it reverses, I'll know if it's a reversal at the time of delivery. So that's why I have to wait. I have to wait for CPI, I have to wait for FOMC, I have to wait for non-farm payroll if I'm going to trade them. Mythbusters, ICT edition. ICT says never trade on Mondays. No, I tell you as a new student learning, don't trade on Mondays. Let Monday trade. Use the information that you get. Once you know how to trade, you can trade Mondays all day long. That's the proper context of what I said. I teach my students don't try to trade non-farm payroll, but you can trade after non-farm payroll. About 30 minutes after non-farm payroll, you can trade the gas, the inefficiencies, and the liquidity. It's easy to trade it after, but it's next to impossible for you as a new student or new trader to feel confident or consistent trading non-farm payroll when you don't have experience. Same way with CPI. CPI can rip your head off. It's so violent, so quick. If you're wrong, it's unforgiving. Okay, so we have a balanced price range in here. A balanced price range. It comes in many forms. I shouldn't say many. It comes in a couple forms. But we have talked about how markets stay in a range. And when they leave that range, because upside and downside has been delivered on price, it makes it a balanced price range. What happens when it's done over the course of a couple candles and not a multitude of candles? Think about it like this. This right here, all of this movement here would be absent from the chart. And you would just see the market would be here one day. And then the next day it would be gapped down here. And then the next day it would be gapped up here. All of this movement would be invisible. All of this movement would be invisible. It would just be looking just like that. That is a key reversal or a island reversal. Once price goes to an extreme, which is what it's doing here, because see what we have here? We have a low. We run through that low and we do it on a very large candle. And then we come back all the way back over top of that again. So these two candles right here, this represents a balanced price range because it's reached down to a level and it's offered on one single pass all this move, and the next candle over here, one single pass. Which is higher? This candle's low that moves back inside of this up move of this candle, this down movement on this candle, eats into this up close candle, but only to this point. This low or this low, which one's higher? Clearly this one. This is the only candle that is defined in the range that this candle goes lower lower and this candle goes lower. So what I'm saying is the range is from here to here, extended out. Okay, so this makes a balanced price range. What I'm looking at is this relationship, because we had single pass down, single pass up, this is balanced now. Once we leave it here, what that means is this range, you define it by what I just showed you here, the highest and the lowest extreme between both of these up close and down close candles, this entirety of that range, low to high. Where are the bodies of the candles over here stopping? I know, it's some serious shit there, ain't it? That's algorithmic. All the bodies of these candles here are respecting the midpoint of this balanced price range. So when I'm watching a balanced price range, or if I make mention of a balanced price range, what I'm suggesting to you is that there is a definitive boundary that at which I don't want to see breached on a candle's body. Okay, I don't want to see it move beyond this. In this case, we were looking for what? For dollar, move lower. So a lower move in dollar is what in other asset classes? Risk on. Risk on is dollar lower. So dollar lower, all foreign currency higher, and it gives the freedom for stock indices to go higher. These candlesticks are supporting the idea of the principle I'm teaching to you. Every time I tell you there's a balanced price range, this is what's occurring. The market's returning back to equilibrium. That's what this is here. Okay, it's not consequent encroachment. It's not mean threshold. It's equilibrium. A balanced price range is going to go back to equilibrium. The bodies in here are supporting that. As long as we don't get any close lower, there is no manual intervention. If it does, there's manual intervention and you abort it. This is just supporting the idea that it's going to go higher. So what you want to see is you want to see the market want to move up and then create more power three. Power three is open, down, close, rally, close on the high. Open, drop, rally, close on the high. Do we see it here? Drop small, rally, up, close. What is the order flow at that time? Bullish. At this time right here, okay, on this candle's close, on the very next candle, on a 15-minute basis, you can use power 3 on that one 15-minute candle right there. As it opens, it drops down. You can be buying anywhere in the upper 50% of this candle here and expect this range here to stay open. Why? Why would this be expected to stay open? You see this candle right here? This is the same thing occurring here with more candles in between. This is all time distortion. I know, this is too complicated. Fuck this. Give me a moving average. But you don't need everything. The same element of delivery here and here, that one single candle right here, imagine this one candle. If all these candles from this candle here to here were compressed into one interval, it would be the same thing happening right there, just more candles. That's all it's happening. So my eyes go into this to this. So now let's use the same criteria, okay? Which is higher, this low or this low? This low. We don't want to anchor it to that. Draw that down. This high or this high? Which is higher, this one or this one? This one. So this high and this low and this high is the two reference points. But you want to expand it down. You want a full encapsulation like we did over here for a balanced price range. In other words, think of it like this. All right, if we were looking at both fair value gaps like this, which one's higher? This one, right? So to identify and map this out, we use this one as the high and we drag it down to here. So all of this is a balanced price range. It should never come back down and through the midpoint of that, meaning there would be a small portion of this gap left open. So let's play devil's advocate for a moment. Say it went down into this range. I would not be concerned about it doing a complete closure here because we have this fair value gap and this fair value gap that basically overlap in this range right there. So we have this portion over here and over here. So this creates what? An island reversal. Multiple candles that are segregated from all the movement here and here. So how I internalize it is all of this right here was manipulation, just like all of this is manipulation. So the purpose is to offset existing liquidity for the purposes of anyone that would be profitable once we get above this high. It's all spending time down there to allow offset longs to be taken out. And who would assume that position if they're getting knocked out? Smart money. These are the two primary functions, okay? Either I'm treating it as a breakaway gap and it should not close fully. This gap here, it should stay open to be optimal. That means it's the best case scenario to see this stay open. I would say that about this one regardless because it would be treated as a breakaway gap. Why? Because this over here is a balanced price range and it's in equilibrium. And the body supporting that idea is seen here. Then we see price moving here and then we have this big extrapolation, but yet to take out this high. So this is the draw. This is where price would want to reach up to because there's real liquidity above here. What kind of liquidity? Buy side. this gap is moving quickly away from all this consolidation around equilibrium based on that balanced price range. For a breakaway gap is expected to form when, for instance, say we're bullish on a market and you have identified a key level that would support as or be presented as support and that is acting as a discount array. Balanced price range at equilibrium. That's one of the PD arrays that is not taught in the mentorship core content, where I show you the PD array matrix and I give you a spectrum of where they are. A balanced price range can exist in any place in a discount or a premium. So there's no real definitive place where they work in an hierarchy, whereas the hierarchy I show you in the PD array matrix, the ones that are there, that is a static, that is very finite. They nest in that order. But there are other PD arrays like this one I'm showing you here, and like event horizon, those things can exist in any range of that spectrum, which we define as a discount or a premium. So even if this didn't have this gap over here that creates a balanced price range between these two fair value gaps, the fact that it does this move here and creates the fair value gap, notice there is no gap here. All through here until this candle forms, no gap is there. Everything is efficiently delivered. Every previous high is touched. Every previous high is touched. This one goes outside the range of it and even goes deeper. But then you have this big extrapolation of the upside. So this gap here, even if this wasn't here as a fair value gap, this gap that's shaded here, I would treat that regardless of the gap on the other side here. It can come back down to half of it, but because there's a balanced price range here, I wouldn't want to see even half of it traded to. It would be optimal for this to remain open. But the very next candle here, the same thing. You would expect it to do what? You can see it open, and then the previous candle's high over here, overlapping this one, that would be otherwise a fair value gap if this wouldn't make the low as low as it did here. This low completely returns back to that candle's high. So any movement from here down into that, you could be a long entry. Or if you're already long, you can pyramid. And then we get one down close candle, and that happens after the high is taken out here. Where does it trade back down into? Relative equal highs. All of this overlapping in between this area here, that is creating a very strong balanced price range in and itself. All of this movement in here is back and forth. Notice that the same things that I'm looking at are continuous. Discount or premium, inefficiency or liquidity. The only separation from those things for analysis purposes is the relationship to the balanced price range or the lack of a balanced price range. All right, so we have all the balanced price range, equilibrium. We have the breakaway gap. We traded above. We have a down close candle. Does it have a fair value gap? What time of day is that? That's your AM session silver bullet. You can trade this gap right here. What time do you start looking for an ICT silver bullet trade? If you're trading in the 1 hour spectrum of 10 a.m. to 11 a.m., you start with your 15 minute down to 5, 4, 3, 2, 1. If you don't see it in the 1 minute or higher, drop down into the seconds charts. If you're adamant about finding one, it will be there. Okay, here's the why behind a silver bullet. They're always going to be there because of the first 30 minutes of price delivery. You have 30 minutes now in the marketplace. The rush, the mad dash to get in there and do something, to buy and sell, that's already in the marketplace now. The initial surge of institutional orders being thrown out there for their clients or their own, that's in the market now too. So now we have 30 minutes behind us, and now we're in the first full hour of trading after the bell. The first 30 minutes is done. That's like the Asian range, okay? Now we have the real move, London. Think about it in the 24-hour cycle. I'm looking at that range of the intraday movement on the morning session as the same impulsiveness that comes into London, where there's a lot of volume that comes in Forex. That same thing occurs in that first full hour of 10 to 11. They all want to make a mad dash to find profitability. And a lot of the algorithms wait for that first impulsiveness to run higher or lower, and that inefficiency that you find on the time frames and the models I'm showing you, they all dogpile on it. It's not a measure of the selling or buying pressure that's pushing it. It's the algorithm itself is offering it to them. The fair value gap doesn't have to form in itself inside of that 1 hour period. It can refer back to some fair value gap that formed, in the run up, if it's bullish, between 9:30 and 10 o'clock. So at 2 o'clock, whenever there's an FOMC event, it's to be treated in 2 stages. The same macro that's being utilized, okay, it's a 2-stage macro. That means it's a first run and then reversal. Most of the time, unless they intervene, that's what the macro will do. But if you wait until these reports come out and that first initial surge and they put the availability of the trade back in place. So think about it like this. At 2 o'clock, we see gold do this run here, rips lower. Remember, this is the low I told you it was going to go to. Did it go to at 2 o'clock? It drops down, but falls short of the objective and then leaves this low and this low as relative equal lows. And then it rips up higher. What's happening here? It's setting the stage for traders to suspect that this is support. We can go long, it's going to rally. It drops, leaves this inefficiency right here. When it drops, it comes back up into it there to offer an opportunity to go short. And then it delivers where I said, which is that relative equal lows on the daily chart. That two-stage or second stage of delivery after 2:30. See, the first move is like a red herring. Hey, pay attention over here. Look at all this. And then at 2:30, that's the real move. It can come in two forms. It can go rally up, suck everybody in thinking it's going to go lower, and then it wipes them completely out and goes lower a lot. Or it can drop lower, get everybody thinking at 2 o'clock that it's going lower, and then at 2:30, it rips and takes out the high that was formed prior to the drop. The other thing is where it drops down a lot, leaves a fair value gap, and at 2:30 it'll go back to the fair value gap, and then the real run comes. Most times it does not do this. Usually it creates a run one direction, and that direction is a complete Judas swing where it runs, creates a high, it doesn't come back to that high, and just makes a lower low on the day. So when you're trading FOMC, you have to know which of the indices that you're going to trade because of relative strength, which one's stronger. There's always going to be a leadership issue, whether it be NASDAQ or ES, Dow. If it's Dow, I just go to ES. If it's NASDAQ, I will trade NASDAQ over ES. If it's anything leading to the weaker or the stronger for the Dow, I always elect to use the ES as a deferment. If it's a matter of picking which index I'm trading, it's either a decision of whether trading the NASDAQ, and it has to be the leadership on the upside. That means it's been going up longer, harder, faster than ES. If ES is going up longer, harder, faster than NASDAQ, if it was reversed in its role, I would have taken this trade in ES and not NASDAQ. So the first delivery at 2 o'clock was seeing price do what? Drop down. I'm going to go into a 5-minute chart. When this market dropped here, where was the most energetic price leg beginning from? All of this starts the run going into FOMC. So anyone that's in this move, where's their stop loss? Right above that short-term high. Why was I going long in here? What was I looking at? This down close candle here. All of this movement in here back and forth, I'm treating that as like a very small little balanced price range. It's doing back and forth, back and forth. So I'm trusting that there shouldn't be any more meaningful run below that if we take out that candle's high. We have it here. That low now becomes, that's it. There's no more need for any more risk going lower. The stage is set because what time is it? 2:25. The macro will run on time. It's going to favor this market because it's been outperforming on the upside. So its sponsorship is heavily on this one going up versus the ES like it's been doing for weeks. And the Dow has already proven it's lethargic. Going long, right here, what am I keying off of? This body of this candle, the last down close candle. This movement down into here, I'm buying that right there. Then I'm using this right here, this opening price, and inside this little area here, I want to use that as a means of wanting to go long on a pyramid. What am I aiming for here? Just before we get to this high, because during FOMC, it could do this wild whipsaw still and then deliver up. I want to get in, I want to get out of my trade as it approaches this high. 2 stages. Non-farm payroll is the same way. It either gives you a drop, come back to a fair value gap and continue, or it gives you a drop and completely reverse and rip higher. Everything reversed. The difference in knowing which one it is how it trades at the time, which is why I have to wait. I have to see what it's doing, how it delivers, and compare it to the other averages. It's not SMT. I'm looking at who's been leading the pack, higher or lower, whenever these reports come out. And then I'm looking for where the liquidity is. Go back and look at your calendar, and every time there was a FOMC rate announcement and a non-farm payroll, study how that liquidity is taken. It's always a 2-stage macro. It always does something initially that gets people thinking it's going to do something specific, and then it rips their face off. CPI is that macro on steroids, and you can't trade that. All of these high impact news drivers and or medium impact news drivers, if you're afraid of those, just wait 30 minutes.